What's going on? Welcome back. Ryan here. In this video, we're talking about the short call and the short put. So remember, we just talked about the long call and the long put, right? Purchasing options outright. And now we're going to talk about the other side of that, which is selling options outright. Okay, so again, I have gold here. I think gold is a good example to use when selling options because people can conceptually understand what taking delivery means, right? So again, if we look at gold here and we think that it's going to go up, right? We could either buy that call, like we talked about before, right? That bullish trade, right? Where here's what buying that call looks like on gold, right? We have our defined risk trade where we can only lose the premium paid for the option. And when we come in here to look at this again, and now we're talking about selling options, where, well, the bullish play when selling an option is to sell a put, right? So if we were to look at selling this 24-day out put, right? So let's look at, maybe we think that gold is not going to go below this 1760 level, right? So 1760, so we want to sell one put, right? And let's analyze this trade, right? So this is what selling a put looks like, right? Where when you're an option seller, remember, we're obligating ourselves to do something, right? We're obligating ourselves to take the other side of the trade for who's ever buying, right? So remember, when someone buys a put, they're basically saying, I'm buying the right to sell. And when you sell them that put, you're saying, I will sell you this no matter what happens, or I will take a long position. So remember, the way that this graph looks here is the profit is capped, right? We can this put, this 1760 strike put on the gold futures had a premium of 1170, right? So 1170 times that 100 troy ounces gives us a premium of 1170, right? So if gold continues to just stay above that 1760 level by expiration, we will keep that money. Now, if it starts to move down, right, we're going to be losing money on this put, right? Here is the break even, which is 1748, right? So if gold is above 1748 by expiration, we still might be able to make money here, because remember, the value of this blue line is the value of the option at expiration, right? And you'll either this will either expire worthless and you'll keep that premium, or this could be in the money and you would then have to take a long position, right? Which would mean for the futures you would get assigned one long gold futures contract, right? If it was a stock, you would be long 100 shares of stock, right, from this strike price. And important to understand that when you're selling puts, it's not unlimited risk, right? Because it could only go down, right, to zero, right? Which obviously gold is not going to go to zero, right? But when we think about selling a put, right, where it's a bullish play, right? We're selling we're selling an option at a level, right? That level might be here, right, where we don't think that it's going to go below this, so we sell this option. But the way to think about this is actually we're creating income by selling this option, and this could also be looked at as potentially trying to buy an asset at a discount, right? Because think about it, we're selling an option to create income, and we might, if the option ends in the money, we might have to take delivery or buy this asset. And when we talk about what are called cash secure puts, we're going to talk a little bit more about this in detail. But just know that there are so many different ways to use options, and that's why it's really important to really study these strategies, study how they work, study the way that you can use them, because there's a lot of cool things that we can do, and this is one of them, right? Being able to create income while potentially buying an asset at a discount. Okay, so again, if we look at this going to zero, remember, we're looking at a gold futures contract. So if we sold a put and then we had to take delivery, let's say we were planning to buy gold futures, right? And we sold this put, right? And now let's say that now it went down to 17. Let's just say that it just finished just below at 1743. So here it goes down to 1743. Our put would be in the money. We would be assigned that long futures contract. And then what would happen is if we held that long futures contract into the delivery period, we would then have to come up with the full value of that 100 troy ounces of gold to take delivery of that gold, right? So think about what those numbers look like. So we bought gold at 1760. That's where we sold the put. So if we times 100 troy ounces times that means that we would need to pay $176,000 to take delivery of our gold futures, our 100 troy ounces of gold. That's how much it's costing us, right? But we tried to sell that put to create a little income, but now we bought gold and we decided to buy gold at this price, and then gold is going to do whatever it's going to do, but now we're long that gold, right? But you can see how easy it is to talk about these things, to think about them conceptually, right? Markets can do a lot of different things, and that's why when we think about different option strategies, whether we're buying calls, buying puts, or whether we're selling calls and selling puts, we have to have a plan that we strategically come up with and that we stick to, right? Because it's when we start trading and we're not quite thinking and we don't quite have a plan that we then tend to make mistakes and we tend to lose. And this often happens with trading options when you're trading short time schedules, when you're trying to do things fast and you don't have a solid plan, right? So let's take a look at maybe a different scenario here. Let's maybe look at Apple, right? So here's Apple, and Apple has just been on a huge tear, right? It's gone up, it's been riding, it's been accelerating up, right? And now it's dropped back down to the mean, and now it's starting to rise again. But let's just think about the other side, the other trade, what we're talking about in this section, right? Which is short call, short put, right? We looked at that short put on gold, right? But let's think about if we thought Apple was going to trade sideways now or continue to trade down, right? We could come into Apple here, and we could look at selling a call, right? So let's look at just selling an at the money call, $175 strike, and we'll sell one of these. And this is a strategy that is unlimited risk, right? Selling calls are unlimited risk because there's no cap on how high an asset can go, right? And when you sell that call, you're obligating yourself to take that short position, and this could, bite you in the butt, right? I mean, if Apple just continues to rise and rise and rise and rise and rise, right? Even one contract, if Apple goes up, continues to go up, you're losing on that trade, right? And important to understand that, right, if Apple continues to go down, again, you would keep your premium for selling that call, right? Which in this case, this Apple $175 strike call, $3.55 premium, right? Which times 100 shares gives you a credit of $355, right? And again, if we cycle through this date, we can see that this purple line, our time value, approaches the blue line, which is the intrinsic value of the option at expiration, right? So important to understand the difference between selling the naked call and having that unlimited risk versus selling the naked put and only having a limited risk because assets could only go to zero, right? Really important to understand, again, the difference between buying options where we're buying rights to do something, right? When we buy the call, we're saying we're buying the right to buy this underlying security at a certain price before a certain date. When we buy the put, we're buying the right to sell, again, underlying asset, certain strike price before a certain date. And then when we're selling these options, we're obligating ourselves to do something. This is like so important to conceptually understand that no matter who I train or how much experience people have, I tend to focus on these things because they're extremely important, and we always have to be thinking about the risk and what can potentially go wrong when we're trading, because things always go wrong. I mean, things go wrong in life, they go wrong in business, they can go wrong in relationships, right? It's always important to understand, especially when we're dealing with these systems, right, and technology, of, again, where we're going to lose. So again, here is this short call, right? And again, we can come on Apple here and we can again look at another trade where we'll look at selling the put again, right? So here is selling the put, right? Right? We can only, the maximum that this can lose is if Apple went to zero, right? If you sold that put and you were long the stock now, right? You sold the put, you got assigned 100 shares of Apple, and if Apple went to zero, you would lose, right? Your strike price where you were assigned times 100 shares, and if it went to zero, right? So there's limited risk when you're selling puts naked to the downside, as opposed to when we're selling the call here, there's unlimited risk to the upside. This is so important to understand when we're talking about selling options, of like understanding where that risk is, right? Selling puts, there's limited risk to the downside, right? Because securities, most likely they're not going to go to zero. But again, when we look at certain companies do fail, right? And important to understand, when we're selling options, where that risk is. So again, selling puts, limited risk to the downside, right? As we can see here, right? And then on the other side of this, when we're selling this call, there's unlimited risk to the upside, right? It just keeps going. You could just keep losing and losing. If Apple went to 80,000, you would be down, what is that, 7,279,000, right? It obviously it's not probable, but it is still important to understand where that risk lies, right? So one more example, let's come into the chart and let's just look at Tesla, right? People have lost a lot of money shorting Tesla, right? So just think about this scenario, like even right here, where Tesla from, about May 13th, right, starts trending upwards, and right here at this point around $800, right, I'm sure there's somebody who sold here, right? They sold a call option, and now the market made a $400 move against you, right? Where when we look at this, think about this. If we let's see the best way to set this up. If we come into like 30 days out and we go into this $800 call, right? And we sell that $800 call. We'll sell one of them. So again, it's a single option sell. We're selling one Tesla January 21st, 22, $800 strike call for $155.65 credit, right? So if we analyze this, we can see that if Tesla goes down, we would be making money, right? The maximum money we could keep on this is that $15,565, right? Because it's 155 points, 65 cents times 100 shares, right? We can see, though, that there's unlimited risk here, and that, if Tesla were to go to, 2,000, you would be down $100,000, right? Which wouldn't happen, right? Because most brokers will auto liquidate you before it ever gets like this. But the problem can arise, and we're going to see this when we start talking about spreads specifically, where you could be over leveraging yourself with a spread where the price of that spread is low, and then something happens and it could really move against you quickly. But again, important to understand that selling calls is unlimited risk to the upside. Selling puts, there's limited risk to the downside. And just important to, again, know what buying options means, know what selling options means, right? Know what buying the call gives you, know what buying the put gives you, know what selling the call, know what you're obligating yourself to when you sell the call, know what you're obligating yourself to when you sell the put. Okay, so again, love talking about this stuff. I hope that my explanations and the way that I'm framing this for you is giving you insight and is helping you conceptually understand this so that you have confidence when you're navigating software, navigating the markets. So again, I have to keep drilling this over and over and over again, because I see too many people make these mistakes on the internet when I'm looking at people's trades that they post online and they can't seem to figure out why they're losing money. It's coming from the fact that you don't have a solid understanding of what it means to buy options, what it means to sell options. This is like the most important part, because when we get into spreads, it's important to conceptually understand the obligations and the rights that we're dealing with, okay? And as you get better at this, though, as you get more experience, as you put this into practice, you're going to see how much fun it is, how lucrative it can be. And you're also going to see, on the other side of that, right? There's no option trader who's not going to experience loss at some point or another, right? Mathematically, when we're looking at probabilities, it's the probability of us losing is substantial, in the sense that not every trade is going to win. And all of this study into these fundamentals is going to give us, the insight and the confidence to know when it's time to like trim our positions, right? To prune them, to get rid of the ones that don't work, and to then maximize the ones that are working. And this is the difference between people who consistently win and people who lose consistently. Okay, so I hope this is helping. I hope that you're getting some insight into these positions, right? The long call, the long put, which we talked about in the last video, and now the short call and the short put. So again, let's just recap. If we're looking at Apple here, remember, when we're selling a call, there's unlimited risk to the upside, right? The only money we can make when you're selling a call is if the market trades sideways or the market goes down, where then we keep the premium that we sold the option for. Again, when you're selling calls, you have that unlimited risk to the upside. And when you're selling the put, remember, there's limited risk to the downside because the asset can go to zero. And then again, you're only able to keep the premium that you sold the option for, right? So let me know if you have any questions. I'm having a great time talking about this, and I look forward to continuing through these strategies and giving you insight into where you're going to make money, where you're going to lose money, and just looking at these the right way. So again, I will see you in the next video.